Hello, everyone, and welcome to today's webinar. This is Steve Wilkes. I'm a partner in the Wagner Law Group here in our San Francisco office, and I work in our investment management law and Erisa Fiduciary Services practice group. Today's webinar is going to be on prohibited transactions, and we're going to focus on the prohibited transactions that are especially of interest, we think, to broker-dealers, but pretty much outside of the investment advice exemptions. We've had so much discussion and focus on the Fiduciary Regulation over the last couple of years and the related exemptions, and to this moment in time, we're still very much living in a world of uncertainty and a lack of finality with how things are going to play out. I think it's important for broker-dealer firms to remember that the prohibited transaction rules of ERISA and the related provisions of the Internal Revenue Code cover many other aspects other than advice. They will touch a lot of assets and a lot of accounts that you hold. So we thought it would be a good time to go back to the future, so to speak, take a look and remind everyone of all the different options that are available and the other exemptions and other transactions that are out there to stay focused on the overall reach of ERISA and the prohibited transaction rules, rather than taking a break, at least for today, from the advisory rule. So we're going to cover what kind of plans and accounts are subject to ERISA and the kinds of prohibited transactions that we have, some different kinds of exemptions. They break out basically into administrative or statutory exemptions, and then some of the specific areas that broker-dealers are especially interested in, trading and securities-type transactions, securities lending, underwriting, margin lending, soft dollars, the corrections exemption. We'll come back briefly. We will make reference to advice. I refer to it here as land of the unknown because we're not sure how some of that stuff is going to play out, but we still need to talk about it. And we'll talk also a little bit about, affiliated brokerage and products and mutual funds and insurance. Now, the purpose today is not to go into a full in-depth explanation of each exemption. They are very technical, as you can appreciate. Just to sort of highlight the kinds of transactions and the broad menu of available exemptions from which you can operate the business. Kind of a refresher as to everything that's really out there. So let's get started. So we know that ERISA is the law that, a little background, we know that ERISA is the law that governs benefit plans. We have the statute and rules that, impose various requirements. With regard to broker-dealers, they have to think, you have to think about fiduciary standards, of course, and also about certain transactions, the way assets are handled, the way certain transactions are conducted by people with, fiduciary or other statuses, such as party and interest status. And, ERISA is going to give us some very specific rules on, transactions between broker-dealers and covered accounts and the way services and transactions are conducted with them. So we have the statute, we have advisory opinions from the DOL, we have some IRS material parallel on the IRA side, we have information letters and a host of materials that guide us in terms of how we're dealing with this stuff. But I think for today, of course, we're going to be focused on, prohibited transactions and how they may be exempted. Just a quick refresher, what kind of plans, what kind of accounts are subject to ERISA? Pretty basic, I think, for this audience. ERISA plans break down into defined contribution plans, plans that have individual accounts, and most prevalent today, of course, you're looking at, self-directed 401ks. That's probably the plan du jour for most people. And then you have defined benefit plans, which are pooled investments, which, provide a defined benefit, and many variations of the same. But these are plans that are subject to ERISA. You also have a host of accounts that are retirement plans, if you will. They're not necessarily subject to ERISA, but they're subject to the parallel provisions of the code, Section 4975. and these are going to be, for the most part, IRAs and KEO plans, the plans with no common law employees. And they all fit here into the scheme of things we need to talk about. I also need to understand a little bit about the plan asset regulation. When you're looking at commingled vehicles or funds of funds, you always need to understand how the plan asset rules apply so that you can determine whether or not the vehicle with which you're dealing is going to be subject to any ERISA prohibitions. So, typically speaking, when a plan invests in another entity, the plan's assets, is the equity investment in that entity, not necessarily the underlying assets, of what you've acquired. So, but you really have to work through the plan asset regulations to fully get there. When an equity interest is acquired in a plan that is, that's not a publicly offered security, or it's a security offered, by an investment company that's registered under the Act, the assets are going to be the equity interest and the undivided interest in the underlying assets, unless you meet an exception, operating company exception or benefit plan investors, that kind of thing. I think the point here is that for broker-dealers, when you're looking at accounts that are investing in vehicle, fund of funds or other vehicles, or your account holder is a fund of funds, you really want to understand the proper characteristics of the plan. You also need to be thinking about special rules that apply to bank funds and, insurance company separate accounts. I mean, clearly the plan asset regs provide that ERISA and these, parallel rules are going to apply to common or collective investment funds and, certain insurance company separate accounts, and that sometimes the accounts of insurance companies that sell certain types of products to a plan, which is subject to ERISA, might be deemed to hold ERISA plan assets itself. So again, you need to understand the look-through rules and to really look at the expansive definition of plan assets to properly characterize and label for your own operations the kind of accounts you're dealing with. Governmental plans, offshore, non-U.S. plans, church plans, unless they elect, are not going to be subject to ERISA, to the federal regime that we're talking about. But remember that oftentimes these plans, government plans, for example, will have administrative or regulatory codes, maybe even parts of their state constitution that mimic, if not directly parallel, ERISA. So you're kind of operating under the same regime with the same analysis, just a different set of rules. So another thing to always remember is, okay, so once you've characterized the account or the investor, looking at yourself, we're not going to get into it today, but, it's really the big question we've all been talking about the last couple of years is, are you a fiduciary? When are you a fiduciary? We're going to leave that for the moment. I do want to remind people, and one of the reasons that we're doing the webinar today is because even though we have all this uncertainty with the fiduciary regulation and the related exemptions, that, as a general, those apply to non-discretionary advice. To the extent you're involved with discretionary authority over an account, you're outside of the reach of the fiduciary regulation and those other exemptions for the most part. I mean, that's really an advisory thing. So discretionary management, you are living in pretty much the same world you've always been in, perhaps with a few nuances here and there. So I think that's really important that you remember that distinction. Sometimes people forget it. And again, I think this conceptually, even without the fiduciary regulation, there may be certain situations out there where there's a carve-out or some exception. The fiduciary rule would have created, the independent fiduciary exemption, for sophisticated parties, where there's they have at least $50 million of management under control. That was a carve out. There were exceptions out there that lurk. There's also the general, the safe harbor for execution of securities and futures trades. The proposed regulation that had a carve out for securities transactions to be executed, where there's a security that's bought or sold, and the price range is within is established. There's a time span. There's a minimum max quality. And, there's some workarounds there from, fiduciary status and certain prohibited transaction matters that are helpful. So that rule is gone. It was baked into the prior rules. What's the status of the prior rules? We're really not sure. So again, it's just something to kind of think about. And this is not only for securities trades, but Dave, the DOL has talked about this with regard to futures trades as well. So, and there's an advisory opinion out there going back to the mid-'80s on it. So the point of the story is here, for just general, generic securities transactions, there might be some regulatory relief available, but you have to really very carefully examine the applicable, the rules to make sure that you have one that's still valid as of today, has not been vacated or needs to be resurrected, and so on. So the thing about ERISA, I think, in the broker-dealer world is that, a broker-dealer, can be executing a trade as a principal or an agent, or it could be it could be selling, could be part of a selling transaction, and it's going to need a prohibited. It's going to need some relief. What kind of prohibited transactions are out there? Depending on the role you're playing, there are really two general kinds, I think, for framing this discussion. Certain prohibited transaction rules are, what we call per se. In other words, they're just automatic. There's no question of intent or subjectivity. And then the other kinds are more judgmental, the fiduciary breaches, the conflict rules. And, when you have the per se prohibited transactions, a plan is prohibited from engaging in very specified transactions with a party that's a party in interest or a disqualified person, unless there's an exemption. And there's either going to be a statutory exemption or an administrative exemption or maybe an individually granted exemption. And the kind of things they're talking about are sale or exchange of property or leasing of property, lending of money or credit, provision of services. That includes brokerage and investment services, custodial services, and the use of plan assets, for the benefit of the party in interest. So I think this kind of sets the frame for the things to think about. Of course, the liabilities from prohibited transactions can be pretty onerous. There's disgorgement, there's excise taxes, there's potential DOL civil penalties, reputational risk. So getting on the wrong side of a prohibited transaction without an exemption can be a very serious matter, and that's why you need to really understand the full range of exemptions that are available to you. As I mentioned before, the exemptions really there's really three general flavors. There's some that are in the statute itself. There's a series of class exemptions that have been granted over time by the DOL, and sometimes people get very customized or individualized class exemptions. So I think that just, generally speaking, there are a couple of big picture exemptions out there that you should be aware of, from the broker-dealer perspective. You might not need to rely on it yourself, but you might need to be aware of it. Probably the biggest one, one of them for sure, is the QPAM exemption, PT 8414. This allows a plan and a party in interest to engage in certain transactions where the transactions are negotiated and they're approved on behalf of the plan by a qualified professional asset manager. That's QPAM. That could be an SEC registered advisor, a bank, or an insurance company that meets certain definitional criteria. There's also an in-house version of that called the in-ham exemption for in-house service providers. And I think the thing that's important here for the broker-dealers to make sure that if you are engaged in a transaction or an account, some decision maker in a transaction that you're involved in is relying on the QPAM. You want to make sure to get the right representations and warranties that they are qualified and they are maintaining an ongoing role and things like that. Then there's another, so you want to get certain reps and warranties, I think, as part of your account opening or part of the transaction. I think also there's another source of funds, very broad-based. I mean, the source of exemptions are very broad-based. Sometimes they're called the source of funds exemptions. You know, these relate to insurance company, general and separate accounts, and bank collective funds, and so on. And these allow for transactions with a party in interest that, without violating the PT rules, provided that all the conditions, provided that all the conditions are met. So again, you want to make sure in any of these situations, broker-dealers, that the account you're dealing with doesn't necessarily contain plan assets, or if it does, one of these broad-based exemptions might apply to someone who's making decisions, and you're going to see this, that you're going to want these representations, warranties in the documentation that you're dealing with. I want to take just one sidestep here for a second, because as I know many of you know, a lot of times the conditions of, sometimes in a statute or in an exemption, there's a requirement for an independent fiduciary. Our firm often, gives opinions on this, or we serve as the independent fiduciary in many situations. And sometimes people say, well, what does it mean? How do you know you're independent? What does it mean to be independent? So back when this all started, back in 74, 75, when Erisa first came out, the DOL, for one thing, they were distinguishing between, certain per se transactions under 406A and fiduciary or conflict transactions under 406B. And under 406B, that is where we saw a lot of the requirements for independent fiduciary to kind of look over the shoulder of the conflicted party and give a blessing. And, there are a couple of different definitions out there in terms of what an independent fiduciary is or what the metric is for establishing independence. Back in one of the very first one, I think 75-1 might have been the very first class exemption ever given. It didn't contain an independent fiduciary requirement per se, but it began to show up a few years later with some of the mutual fund transactions and insurance company type transactions, and they asked for either a second or an independent fiduciary. And in those, they defined independent to mean a person is independent only if that person, that independent fiduciary, had no relationship to or interest in such person that might affect the exercise of such fiduciary's best judgment as a fiduciary. Not the most specific definition in the world, but it was helpful. It gave some parameters. Some other exemptions will tell you what independent is by telling you the opposite. They'll define what non-independence is, and then therefore if you don't meet the definition of non-independent, you're deemed to be independent, and so on and so forth. But I think it's just a heads up for everyone that when you're dealing with different transactions, different exemptions, sometimes the definition of independence or the metric of defining independence may be different, and I think you really need to keep track of it. So even going, and just to round out the conversation, even now into recent years, beyond the very beginnings of Erisa, you see this ongoing requirement, for independence. We saw it in the participant advice regs that came out in the Pension Protection Act, with looking for independent audit, so to speak. And there are many other examples where independence is a big requirement. So that's just a heads up for you to be mindful of, okay? Let me just also just very quickly kind of knock out for you, if you will, a lot of this stuff is in statute. A lot of times people forget that we have a lot of statutory exemptions. They're right in the statute. It's not just the class exemptions that the DOL has granted or you have to apply for one individually. There's a lot of stuff in the statute, and especially back in 2006, the Pension Protection Act, they came out with that's when they really loaded up on them. So I'm just going to run through a couple of them for you to make sure you're aware of everything and that you're being mindful. I said before, the participant investment advice exemption came out, and that was for, again, not for discretionary management. That was for advice to plan participants who direct their own accounts, and that was in 408B14. Of Erisa, and there's also been a field of assistance bulletin in 2007 about the scope of the exemption, and so on and so forth. So here they talk about investment advice that would make a person a fiduciary, and they talk about advice advice provided by a fiduciary advisor. It has to be under an eligible investment advice arrangement. And there are two basic flavors. There's a fee leveling option and there's a computer model option. We're not going to go into all the details. I just want to remind you, some people are forgetting that, maybe there's some benefit here, notwithstanding the concerns raised under what looks like the vacated fiduciary rule. I'm not sure exactly where that's going to end up, but another alternative might be taking a look at the participant advice exemption under the statute and see if that is helpful or not. I think also there's a broad, what we call the service provider exemption that was added a few years ago. It's not the 408B2, but there's a very broad service provider exemption under 408B17, and it covers, the purchases and sales and credit transaction with a person who's a party in interest to a plan solely by reason of providing services, but other than a fiduciary that exercises discretionary authority or renders investment advice. And it says that the plan receive no less and pay no more than adequate consideration. So there might be some exceptions there as a service provider that are helpful to you. There's also an exemption, as I'm sure many of you are aware, for block trades. I'm always surprised that a lot of these statutory exemptions, when we talk with clients, people aren't always aware of them or they're not utilized as much, when they can be. And block trading covers the purchase or sale of securities or certain other properties as the DO would define it. It's with a party in interest other than a fiduciary in a block trade. And a block trade is anything at least 10,000 shares with a market value of at least $200,000 that goes across two or more, unrelated accounts. And there's some other terms and conditions that go with that. There's one for electronic communication networks and the 408B16, which is pretty interesting. And there's a few others on cross trading and on corrections. I'm going to mention corrections a little later, but I'll talk about it now as well. And we'll come back to it again. And the corrections is pretty powerful because it gives you a chance to go in and kind of undo and remediate a problem that you have. It provides an exemption for a transaction that's involved with the acquisition or holding or sale or disposition of a security or commodity. And there's a correction period of 14 days. And by correction, they're saying that they define correction to be the undoing of the transaction to the extent possible and making good to the plan and the resulting losses and restoring profits made through the use of plan assets. It doesn't apply to transactions with the plan sponsor or affiliates involving employer securities or real property, or to a fiduciary or to a knowing participant, but there might be some relief there. And there's some other ones as well. There's also the good old, the standard service provider exemption under 408B2, and that's where all, of course, our disclosures came out a couple of years ago, for necessary services, and it has to be a reasonable arrangement. Again, it can't be in excess of reasonable compensation. Always a challenge. And there's a couple of exemptions available for banks and other entities under 408B4, 6, and 8 that would really help with cash sweeps and bank products and ancillary services and things like that. So review the statute for these. These are just an example. I think I have most of them here, but this is an example of some of the statutory exemptions that are available. Very helpful, very powerful, and something that you need to refresh on. So when you move beyond the statute, let's look at some of the class exemptions that have been given and see what we want to say about those. I mean, basically, agency trades for a broker-dealer, are obviously very common. One of the most common things you're going to be involved with. I think they really break down into agency trades where you're, a fiduciary and you can rely on prohibited transaction 86-128, or you're acting as a non-fiduciary party in interest, at least with regard to the assets that were involved in the transaction. And here, maybe just the service exemption under 408B2 or the traditional securities exemptions under 75-1 will be helpful. But so where you're acting as a fiduciary, if you didn't have an exemption, it would be a prohibited transaction for broker-dealer, to affect or get involved with a securities transaction or perform services. But this is a pretty, common practice for fiduciaries, in the industry for broker-dealers. So they came out, the DOL granted, a bunch of exemptions, and eventually it morphed and evolved into 86-128. And under that exemption, a broker-dealer that's a planned fiduciary, where maybe it's rendering discretionary advice, for example, or a broker-dealer that's an affiliate of the investment manager, is permitted to effect or execute securities transactions and to get a fee, and also, do clearing and settlement and custody, for example, provided that the fees aren't excessive. And there are various conditions that need to be met. And those are all enumerated in the exemption. Now, there also might be situations where the broker-dealer is not a fiduciary, but you're a party in interest. And this is when you go back to the old traditional 75-1, Part 1, and that would allow a plan to buy and sell securities using the broker-dealer as the broker, provided that, that the broker is compensated on an arm's length basis. And again, this also covers other services, including, maybe, the way it was written back then, including the furnishing some advice about the value of securities and so on. But I think, the impartial conduct standards had been extended out to 75-1 under the reg, and now they're potentially vacated. We're not quite sure what's going to happen. So this is an area I think we really have to keep our eyes open and be careful. So I'll just put it out as a general proposition that we have this traditional exemption under 75-1 that we need to look at very carefully on a going forward basis. But there are exemptions available for both fiduciary and non-fiduciary roles. And then, there's also, you can look at PTE 2002-12, in terms of cross trading. So again, here, the DOL takes the position that, if you don't have a statutory or administrative exemption, fiduciaries certainly can't execute cross trades on a discretionary basis. So it's kind of a problem. But the DOL has granted a number of individual exemptions over the years. But then you have kind of a limited, a little bit of help. 2002-12 is what they call the passive cross trade exemption. These are trades that involve index or model driven funds. And then, of course, you look to the statute, to ERISA 408B19, for discretionary cross trades involving larger plans, and there's some relief there. So if a manager does not exercise discretion on both the buy and the sell side, maybe 86-128 will give you enough latitude to execute an agency cross. These are all different things that, it depends on the nature and the manner in which the transaction is being handled. But these are all things that can be done, and there's a lot of relief and a lot of opportunity that you can handle. I think on the principal transaction side, it's another whole world to think about. Again, you have to, I think, break this down to situations where the broker-dealer is a fiduciary or not. Principal transactions between a plan and a dealer, you might have a situation where the broker-dealer is a fiduciary. There are certain exceptions that are available for market making. But the old 75-1 gave some limited exceptions for the purchase or sale by securities of mutual funds. with some conditions. No fiduciary who makes the decision for the plan to enter into the transaction is the principal underwriter. The transaction is at least as favorable to the plan in arm's length. Plan maintains records, so on and so forth. And there could also be situations where the broker-dealer is not a fiduciary, but is a party in interest. And here, principal transactions between a plan and the broker-dealer, it's not a fiduciary, it's a party in interest, and the dealer is not a market maker, and it's not acting as an underwriter. There are some exceptions. There are some ways to do this under PTE 75-1. You have to be registered. The broker-dealer does not have any discretionary authority with respect to investment in plan assets, something that the broker-dealer customarily does for its own business. In the ordinary course of his business, I should say, favorable transaction, good market transaction. You also have got Erisa section, the statutory exemption of 408B17. So there is relief under, there are some solutions and ways forward under both the statute and under the exemptions. Again, the caveat, they had extended the impartial conduct standards now to some of these. Now they're obviously cut back. So we need to, going forward basis, as you're engaging in your business, you need to look really hard at the particulars of the transactions and see exactly where we lie with the available statute, if there is one, or the particulars of 86-128 or 75-1. Make sure you're in the right section of 75-1, and just see if it has been at all curtailed or hindered by the impact or the effect of what's happening with the fiduciary regulation. Securities lending is an area that is of great interest to people. We have there's different kinds of lending. I mean, there's margin lending. There's all kinds of transactions that are going on. But for example, like in terms with margin lending, ordinarily an extension of credit to a plan would be a prohibited transaction. You have this margin lending exemption under 75-1 that allows broker-dealers to provide credit. If it's in connection with the ordinary settlement of a trade, the ordinary course of business, the broker-dealer is registered, broker-dealer can't be a fiduciary, the credit is part of the purchase or sale of securities, otherwise lawful. So these are, there's lots of room here. On securities lending, again, a borrowing of securities, could be a problem unless you have an exemption. But you've got 2006-16. This was an evolution of a prior exemption or exemptions that ultimately became known as, numbered as 2006-16, and it covers securities loans to certain institutions and to certain non-U.S. banks and non-U.S. broker-dealers. Again, there's a lot of requirements. The broker-dealer has to be registered. The borrower, I should say, of the securities would have to be a broker-dealer that was registered or exempt from registration, perhaps, as a dealer in securities. There's a lot of conditions as to who the borrower is. No discretionary authority or advice involved. There's some requirements on collateral in terms of, the market value and whether it's posted as, U.S. or foreign collateral, things like that. Certain documentation, the loan agreement has to be in writing, has to be audited financials, compensation must be reasonable, must be reasonable termination provisions on the loan and reasonable default provisions. But again, there's a whole way forward, if you will, in terms of how to deal with securities lending and margin lending that's spelled out under the exemptions. In terms of soft dollars, which is a very important area, the thing I would say here is that if you're okay with the with the treatment under the securities law, under the treatment of the securities law, it's going to be okay. So the Department of Labor, has their, technical release 86-1, and, what they really said here is that if you meet the safe harbor under 28E, you should be okay. Clearly, soft dollar and directed brokerage policies are, kind of, fiduciary type activities and should at least be monitored in accordance with ERISA. And, the DOL feels that an investment manager that is using soft dollars, could potentially violate ERISA because part of the commissions, could be used to purchase research services or other services, and they don't necessarily go to the plan for the benefit of the plan that's generating those commissions. But, there's a safe harbor under the Securities Exchange Act under 28E. I think there's a lot of confidence, in that particular program. So that's going to be your way forward in terms of soft dollars. Underwriting transactions generally are going to be an area that that you need to focus on. Again, we want to distinguish between situations where the broker-dealer is a fiduciary or a non-fiduciary. If the transaction is involved with respect to a broker-dealer who's a fiduciary, if the broker-dealer is acting as an underwriter regarding with respect to a security, selling that security to a plan where it or an affiliate is a fiduciary, you have a prohibited transaction. So understanding that a lot of times broker-dealers are members of syndicates, the DOL granted an exemption in Part 3 of the old 75-1 to permit certain purchases by plans from underwriters or syndicates where the broker-dealer is a fiduciary or its affiliates are involved. And this could involve situations where you're the syndicate manager. It could involve situations where you're not the syndicate manager, but you're purchasing from syndicate members, other than the fiduciary. It could involve situations where the broker-dealer is not a fiduciary at all, but is simply a party in interest. And, they lay out all the kind of the guidelines here for underwriting transactions in 75-1. And the example of, the kind of conditions they're looking for. For example, if the plan fiduciary is not the syndicate manager, if there's no fiduciary involved in causing the purchase from the syndicate, the plan can purchase, security from the syndicate, other than from the fiduciary broker-dealer, if I think, all of the following conditions are met. The securities, they'd have to be purchased at a price not greater than the public offering price prior to the end of the first day. The securities are all registered under the 33 Act or properly exempt. The securities are offered pursuant to an underwriting agreement where members of the syndicate are committed to purchase all the securities being offered unless the securities are purchased by others pursuant to a right offering. The plan doesn't acquire over 3% of the total offering, and so on. There's a host of other rules that apply. So underwriting transactions, again, can generally fit in here. We have to break out between fiduciary and non-fiduciary roles. Margin lending is the same. We talked about that a little bit before. It's under 75-1. Has certain requirements, where it's a registered broker-dealer, not a fiduciary role, and the loan is for acquisition of securities, and and it's otherwise permissible under the regs and under the law. There's also, a lot of we had some calls the other day. There's a lot of interest in purchase and reverse purchase kind of transactions. We get those calls every now and then. And they can be done clearly. Prohibited transaction 81-8 can be used for repurchase agreements, and if it's a reverse repurchase, maybe 2006-16, maybe one of those broad source of funds exemptions I talked about before would cover, maybe the QPAM. But generally speaking, under 81-8, there are various various conditions that have to be satisfied, and they relate to kind of some characteristics of the seller. And the seller must be a broker-dealer that's registered under the Act, or a dealer who makes primary markets in government securities, for example, or a bank supervised by either the federal or state authorities. No counterparty or its affiliates can have any discretionary authority to control or render advice with regard to plan assets. The plan has to have securities or CDs or something that have a market value that equal at least 100% of the purchase price of the securities. And if the value of this collateral falls, the plan has to have the right to get more collateral within a certain number of days. There has to be audited financial statements and unaudited financial statements for certain periods of the counterparty. Everything has to be in writing. The repurchase agreement has to be in writing. The term of the agreement itself cannot exceed more than 1 year, and the securities that are received by the plan can't be restricted. So there's a lot of rules that go into that kind of transaction, but they are available. In terms of just generally speaking, returning commissions, a firm might want to return some of the commissions it's getting on trades or transactions, and I think that can be done under Erisa. But I think it suggests and requires that the rebated money must be put to a proper use. It can't pay for expenses or be used for something that would in and of itself be impermissible or create a prohibited transaction. They can only be used for to pay for expenses that are clearly liabilities of the plan, not for the plan sponsor, and these expenses were properly incurred by the plan. A lot of times people do this accounting at an omnibus level, but rebates really need to be carefully accounted for, and they need to be credited. They need to go back directly down at the plan level. They can't be kind of mishmashed up at the omnibus level. You have to be very careful on the accounting for them. They have to be allocated properly. And of course, every underlying trade to begin with, I think, must have been done on a best execution basis. We talked a little bit about corrections before. I just bring it out here again because people forget about it, but 408B20 provides a corrections process for going forward, and there's some definitions of securities and commodities, but you're generally getting a 14-day cure period. You have to undo the transaction to the extent you can and make people whole. Those are the general concepts of it. There's some specific definitions on security, what constitutes a security for purposes of this exemption, and the same for commodity. So it's pretty important. There might be certain contracts or investment papers that might not fall into those definitions. There's a lot of activity with insurance. So I just want to remind people on some of the things that are happening with insurance product, because a lot of insurance product flows through broker dealers. Now we know we had quite a bit of conversation over the last year or two on variable and fixed product and which exemption that would be under, and that can be a little bit confusing, and people are kind of back where we started right now. I'm not sure where it's all going to end up, but there are some other instances where insurance is involved, and I just want to make sure that you are aware of it and thinking about it. So insurance, there's a provision, the statute in section 408B8 provides certain relief for certain kinds of insurance transactions, and you have the 8424 and 77 4, which are going to be helpful in certain insurance transactions. So 408B8, it's really kind of focused on the purchase or holding of insurance products, and it allows a plan to purchase or sell interest in a pooled fund maintained by an insurance company that's qualified to do business in the state, provided that the company is paid no more than reasonable comp and the transaction is authorized in the plan document or by a fiduciary. And this gives you per se relief and some relief under 406B, but not 406B3 for self-dealing. So that's a good statute to be aware of. I think also that 8424, permits the purchase with plan assets of insurance contract from an insurance company, where the agent or where the purchase was put in place by an agent or a broker or a pension consultant, and there were commissions paid, and the insurance company or the pension consultant is a party in interest, and including a fiduciary, but not a trustee or certain other people. So there's remember that there are some things in the insurance world that can be handled in that statute. And the old 77-4, the mutual fund, the affiliated mutual fund statute, this is also available in respective insurance companies' separate accounts that are invested in mutual funds. Then there are some other exemptions that, allow the transfer of certain life insurance and annuity contracts to a plan by a participant or by an employer, or from the plan to the participant and other people, and those go back quite a while. Those go back to 1992 exemptions, I think 92-5 and 6 or 7, something like that. So just a lot of other things to keep track of. Mutual funds, I think everyone is pretty much aware. 77-4 is is an offsetting mechanism where if your broker-dealer firm is in an advisory role, an offsetting mechanism for certain fees, which can be very helpful. And I think that's it. We covered a heck of a lot of material there. I hope it didn't come at you in too much of a rush. I just wanted to run through some of the lists of transactions and just show you the number. We didn't even approach all of them. There were many more, but just show you the breadth and reach of class exemptions in the statutes and how they touch so many other areas of the broker-dealer business outside of the pure investment advice arena that we've been focused on so heavily over the last couple of years. So I want to thank you all for attending. If you have any questions about your delivery of products or services to parties in interest or among fiduciaries or to any kind of customer account, and you're not sure if you need an exemption or how they work, please get in touch with me. We'd be glad to talk with you about how that exemption may or may not be applicable, or if you're looking at the wrong exemption, maybe we'll help you identify another one that works for you. This webinar and the material will be posted on our website within the next day or so. So if you need copies of it or want to hear it again, it'll be accessible on the WagnerLawGroup.com website. Thank you very much for attending, and I hope you have a good day.